Hello and welcome back to the Investing Fundamentals series on Gabelli TV. As I'm sure you know by now, I'm Miles McQuillan, Assistant Vice President on the Private Wealth team here at GAMCO. There was a recent article in Barron's on the tax dynamics of inheriting an IRA. And at Gabelli, we always say it's not what you make, but rather what you keep. Today, my goal is to summarize the article for you. If you've recently inherited an IRA, I can imagine navigating the tax implications can feel like a daunting task. Understanding the changes brought about by the Secure Act and the various options available to you is crucial to avoid a hefty tax bill. First, it's important to recognize that the rules for inherited IRAs changed significantly on January 1st, 2020. The Secure Act, which came into effect on the state, altered the way required minimum distributions, also known as RMDs, are handled for most beneficiaries. Before this law, beneficiaries had more flexibility with their withdrawals, but now most must follow the new 10-year rule. If you inherited the IRA before 2020, you were grandfathered in, so don't worry. This rule requires beneficiaries to withdraw all assets from the inherited IRA within 10 years of the account holder's death. While this may not seem like a long time, it can still pose a challenge when planning the withdrawals to minimize taxes. The key here is to avoid withdrawing large sums that could potentially push you into a higher tax bracket in any given year. Beneficiaries are categorized into two main groups: designated and non-designated. Designated beneficiaries, including spouses, non-spouses, trusts, and estates, have different options. For example, a surviving spouse has a choice to treat their inherited IRA as their own, potentially offering more favorable withdrawal options and tax implications. On the other hand, non-designated beneficiaries, such as charities, have to withdraw the funds within 5 years. Tax implications are another crucial consideration. Withdrawals from an inherited IRA are taxed as ordinary income, which means the amount you take out will be added to your taxable income for the year. Hence the importance of strategic planning. Spreading withdrawals across multiple years can help you manage your tax bracket and avoid large unexpected tax bills. It's also important to note that the current tax rates are scheduled to expire at the end of 2025. Originally lowered from the Tax Cuts and Jobs Act of 2017, we may see a reversion back to higher levels. While obviously there's no guarantee, taking a higher distribution now could potentially shave your tax bill going forward. Given the complexity of these rules and the potential for significant tax consequences, it is always highly recommended to consult with a financial advisor or a tax professional. They can provide personalized advice and help you develop a strategy that fits your specific situation, ensuring that you handle the inherited IRA in the most tax-efficient manner possible. As always, thank you for joining us. Please reach out with any questions or suggested episodes, and we will see you soon.